Welcome to our semi-annual State of the Markets presentation for mid-year 2022. I'm Tony Parrish, Chief Investment Officer of AlphaStar Capital Management. In this presentation, we'll summarize all the major factors that are influencing investors and give some recommendations about how investors should be positioned in the second half of this year. What you'll see is that we are currently at an inflection point in the markets. Those who follow the markets closely and pay attention to the evidence know that we frequently find ourselves in an environment when the direction is clear, either up or down. In those times, there's strong bullish momentum or strong bearish momentum, and we can form an outlook with a high degree of conviction. The second half of 2022 is not one of those times. As you will see, the current state of the markets is highly unpredictable, and that has implications for investors. Here's our agenda. We'll look at the first half of the year, what happened. We'll take a look at our outlook for the second half of the year, and then we'll talk about positioning for investors, how investors should be positioned given the uncertainty that we're currently facing. Okay, let's start with our first half review. At the beginning of the year, we said 2022 would likely be a pivot year in which many conditions for investors would change. Now remember, coming into this year, we had experienced incredible bullishness across all segments of the capital markets in 2020 and 2021. However, we envisioned a more difficult 2022. Here are the elements that we described at the beginning of the year: a hawkish Fed, waning effects of fiscal stimulus, a global economic slowdown, a tight labor market impacting inflation and stock prices. And we said that investors should be cautious. They should be positioned defensively. They should not chase returns. They should favor companies with pricing power. They should favor non-cyclical sectors, and they should seek alternative sources of income beyond traditional bonds. So coming into the beginning of this year, that was an example of how we had a high degree of conviction in our views. We had incredible momentum previously, and we thought that momentum was going to slow, and we believed it was important for investors to be defensive. That was at the beginning of the year. Okay, so what happened during the first 6 months of 2022? Well, consistent with our calls for caution, all major stock segments declined during the first half of the year, as you can see on this chart. In fact, all industry sectors declined, with the exception of the energy sector. Energy, of course, was lifted by the conflict in the Ukraine, the sanctions on Russia, and the oil disruptions that followed. Note, the largest declines on the right-hand side of this chart were among those sectors of the stock market that rose the most in 2020 and 2021. Technology, communications, and consumer discretionary. The ones that rose the most in the previous 2 years fell the most in the first half of this year. In the bond market, all major segments declined as concerns about inflation and the activities of central banks around the world pushed interest rates higher. Of course, as interest rates go up, bond prices fall. There's an inverse relationship there. And we see that the first half of 22 was the opposite of 2020 and 2021, 2 years when returns for investors were strongly positive. This year has been one of the most challenging years for investors in memory. By the way, we included Bitcoin on the far right-hand side of this chart for reference. We did so to show how volatile cryptocurrencies can be, not because we recommend using Bitcoin or cryptocurrencies as a vehicle for long-term financial planning. We do not believe you should be saving for your retirement using cryptocurrencies. Okay, so why was there such weakness across the global capital markets? Well, several reasons. There was dogged inflation in the first half of the year and continues to be as we move through 2022. There were rising interest rates. There was a global economic slowdown. There were high asset valuations in stocks, in bonds, in real estate, pretty much in everything. Asset prices had really increased coming into 2022. Of course, there were geopolitics with Ukraine, Asian tensions, etc. And there was the persistence of the COVID pandemic. This darn pandemic has not gone away and has continued to cause disruptions in the labor force, global supply chains, consumer spending habits, etc. So All of these things, these 6 things, were clearly reasons for weakness in the markets in the first half of 2022. However, there was one thing that eclipsed all of those in importance in our view, and that was the end of the Fed put. In our view, the main reason for weakness was the end of the Fed put. What is the Fed put? Well, the Fed put describes the belief that the US Federal Reserve, the Fed, would step in with accommodative monetary policy to support markets if market prices fell too far too fast. The Fed did exactly that in the late 1990s with the Asian currency crisis and problems with long-term capital management. It did so again during the 2008 financial crisis, and it did so once again when the COVID pandemic hit in 2020. So this belief that the Fed would step in to support markets, the Fed put, this belief in the Fed put caused investors to take greater amounts of risk than they normally would. Now, however, the Fed has clearly shifted its focus to address inflation. There is no longer confidence in the Fed put, and investors have been de-risking their investments accordingly. This, in our view, is the #1 reason why markets experienced the magnitude of weakness that they did in the first half of 2022. Okay, now that we've covered what happened in the first half of the year, let's shift our outlook towards the second half of the year. Reading the economy has rarely been this difficult. Remember, at the beginning of the presentation, I said we're at an inflection point. It's tough to make a call one way or other. COVID supply chain issues, changing consumer habits, the conflict in the Ukraine, and inflation shocks have scrambled most of the traditional metrics that we use to assess the strength of the economy. Are we in recession? Well, as of right now, in August 2022, we don't know. Although the US has had 2 consecutive quarters of contraction, and some people use that as the unofficial metric to determine when we are in recession, this doesn't really feel like a recession in the traditional sense. Consumer spending is high, unemployment is low, etc. There are lots of reasons that we'll go into. So as of right now, we may be in recession, we may be not in recession. We do know, however, that the world's major economies have been slowing and are predicted to keep slowing. The top 4 economies in the world are the US, China, Japan, and Germany, and these 4 economies together account for roughly 1/2 of the entire world's economy. And these economies are projected to slow this year and on average slow next year as well. That does not bode well for the world economy. It does not bode well for recession. Meanwhile, uncertainties and risks have been rising. This chart shows global fear of recession and uncertainty related to monetary policy and national security as defined by the IMF. These metrics indicate that fear and uncertainty have been increasing in 2022. Of course, the most important topic for investors in 2022 is inflation. And with all its implications for the markets and the economy, inflation is such an important topic that we continue to monitor. This chart shows the Alpha Star inflation indices, and their levels continue to be higher than at any time since the early 1980s. Note, since the Alpha Star inflation indices are composites of multiple inflation indicators, they measure both the height of inflation and the breadth of inflation. Currently, levels show that inflation is both high and deeply entrenched in the economy. So the message is investors should be prepared for a prolonged period of higher than average inflation. Be prepared for inflation to stick around. Of course, the biggest question of 2022 is, can the Fed orchestrate a soft landing? That is, can the Fed cool the economy just enough to control inflation without sending the economy into recession? A history of the last 10 rate hike cycles shows the job is not impossible, but it is difficult. So this blue line in the chart shows the Fed funds rate, that's interest rates, and the gray bars show times of US recession. Although this chart shows there were only 2 in the last 10 rate hike cycles when a recession was avoided, it is important to make a couple of observations. First, the Fed's goal in the early 80s, there were 2 recessions in the early 80s, and at that time the Fed's goal was not to achieve a soft landing. The goal at those times was to break the back of inflation, break the inflation cycle at all costs. So those two hikes should probably be removed from this soft landing chart. Additionally, although a recession materialized in early 2020 when the COVID pandemic hit, it was caused by the pandemic, not by the Fed's interest rate policy. So we should probably remove that last, that last rate hike cycle from our soft landing chart. Nevertheless, these adjustments, if we were to remove the two recessions from the early 80s and the recession of 2020, these adjustments do not change the broad view that achieving a soft landing is impossible. Is not impossible, but it is very difficult. Although we've been focusing on the negative attributes of the environment, right? We talked about global economic slowdown and inflation and Fed's tough task ahead. We've been focusing on these negative attributes of the environment. It is important, however, to point out that there are also several reasons for investors to be optimistic currently. And that's precisely why it's currently very difficult to predict how the second half of the year will unfold. Perhaps the brightest area of the economy is the labor market. The labor market is exceptionally strong. This chart shows the unemployment rate, which is as strong as it has been at any time over the past half century. That bodes well for workers, it bodes well for households, it bodes well for the economy, and that is a reason for optimism. Also, stock valuations are not as inflated as they were earlier in the year. That is one silver lining of the 2022 bear market, and that is stocks are cheaper now than they were at the beginning of the year. So this chart shows the price to earnings ratio of the S&P 500. We could have used any number of examples. We could have used, price to book or price to sales or any other valuation metric, but they would all essentially say the same thing, and that is stocks have become more affordable in recent months, and that is a sign of optimism. That silver lining also surrounds the bond market. With the rise of interest rates that hurt bond prices, right? Bond interest rates and prices are inversely related. When rates go up, prices go down and vice versa. With the rise of interest rates that hurt bond prices, bonds are now delivering more income to investors than at any time over the past 5 years. Another way of saying that is getting 1% of income is cheaper now. For every 1 additional percent of income that bond investors are getting, it is that much cheaper now than at the beginning of the year to generate those yield levels. So that is an area of silver lining. And as for inflation, the markets are predicting that the Fed will have to raise rates until January 2023. As of right now, the target Fed funds rate is in the range of 2.25% to 2.5%. If the market's predictions are correct, that means we can expect to see rates rise roughly 1% more before they peak at around 3.4% in the early part of next year. Now, these predictions will certainly change in the coming months. However, they indicate there may be some light at the end of the inflation tunnel, which of course is good for investors. So in summary of this section, the investor's cup can be seen as either half full or half empty, depending on the data points that we choose to highlight. So now let's explore what to do with this information. Let's move to the final section of our presentation that asks the question, how should investors be positioned in the second half of 2022? These are the 3 most important variables that are known to investors currently. We will be monitoring how successful the Fed will be in accomplishing its goals. We will be monitoring how the labor market evolves in the second half of the year, and we will be monitoring how persistent inflation remains for the second half of the year. Let's go into each one. The variable, success of the Fed. How successfully will the Fed be in controlling inflation? Well, that remains to be seen. The Fed's 2021 view that inflation was transitory or temporary, that clearly damaged their credibility. Inflation was not transitory in retrospect, and if anything, it has become more pronounced and more deeply entrenched in the economy in 2022 than it was in 2021. So the Fed must get control of the inflation narrative and convince the markets that they are monitoring conditions accurately, They are interpreting those conditions correctly, and they are responding to those conditions appropriately. The question remains for investors: how much economic pain will be required to get inflation under control? The second variable has to do with the labor market. Despite the slowing economy, the US labor market, as we said earlier, continues to be exceptionally strong and resilient. This is a reason for optimism. However, as monetary conditions tighten and interest rates go higher and economic conditions slow, there will almost certainly be some effects on the employment situation. So the question for investors is, how strong will the labor market be as the economy slows? And finally, the 600-pound gorilla in the room, inflation. This is the single largest factor in the capital markets. Will supply problems get fixed? Will declining aggregate demand cause prices to drop? How will inflation evolve throughout the rest of the year? We don't know yet, but we will be monitoring these conditions of inflation very closely. So the takeaway on this slide, and really this slide is kind of a capstone slide for everything that came before it, is as follows. We believe the markets will remain choppy and volatile and unpredictable until inflation expectations become anchored. So long as high levels of inflation uncertainty persist, keep your seatbelts fastened because we could be in for a bumpy ride. Zooming out at the big picture, how should investors think about this environment? Well, the goal in this kind of environment of uncertainty, where it's highly uncertain which direction the markets will take, higher or lower, the goal is not to time the markets by substantially changing the overall risk that you're taking. In fact, given the fact that we are currently in an unusually uncertain time, and rarely has it been this difficult to read the direction of the economy and the markets, making a mistake in 2022 could be even more costly to investor returns in portfolios than other times. That means if we get too aggressive and the markets roll over, we could suffer very painful losses. However, on the contrary, if we get too conservative and the markets take off, we could miss out on a potentially explosive rally and face having to buy back into the markets at much higher valuations. Therefore, now more than ever, the goal should be to make sure you have the right amount of risk for your specific situation over the long term, regardless of what happens for the second half of the year. There are certain timeless principles. I'll leave you with this. Timeless principles of portfolio management that we can follow. Although no one knows if the markets are going to rise or fall in the second half of the year, and this year is especially difficult to predict, investors should focus on the things that can result in different outcomes regardless of the market's direction. Those are: 1, asset allocation is more important than security selection. What do I mean by that? I mean your exposure to stocks, bonds, and other securities matters much more in determining the risk of your portfolio and the outcome of your investment strategy than stock picking one stock over the other or one bond over the other. Asset allocation is more important than security selection. 2, it's about time in the market, not about trying to time the markets. As we said on the previous slide, if we try and time the markets and we get them wrong, that can be even more costly than if we had just stuck to the plan. So really, if we believe in the idea that markets go up over time, which I sincerely do, then the goal should be to be in the markets rather than trying to time when to get in and out of the markets. Third, investing involves trade-offs. There's no silver bullet. Those trade-offs involve prosperity, certainty, and liquidity. Prosperity is the ability to grow your wealth. Certainty relates to the predictability of the outcome, and liquidity relates to the ability to sell or redeem without any penalty. You can typically get 2 of these 3 things in a security, but not all 3 at the same time. For instance, stocks offer prosperity and liquidity, but not certainty. Bonds tend to offer certainty and liquidity, but not prosperity, etc. Investing involves trade-offs. That's the point. 4, control the controllables. control the taxes you pay, control the expenses that you incur, and control the location of your assets. Location of your assets really refers to making sure that you have the right types of assets in the right types of accounts. And that largely depends on the tax characteristics of those accounts, how taxes are treated for the securities in your account. And then finally, 5, build your core portfolio for the long term, whether markets rise or fall. That goes back to it's about time in the markets, not timing the markets. Build your portfolio for the long term. Make sure that you have the right allocations, the right investments for your long-term goal. If you feel the need to make changes, do so at the margins, not in the core portfolio. Your core portfolio should not change based on the headlines that are happening. Now, if you do have life changes, like you retire, or you get a new job, or you have a change with your spouse, or or any other kind of major life changes that will change your earning or spending habits, those are certainly valid reasons to change your core portfolio. And make sure that you have the right core portfolio in place at different stages of your life. However, whether you believe the markets are going to rise or markets are going to fall, or headlines are bullish or headlines are bearish, those things really should not force you or cause you to change your core portfolio. Remember, we have all the tools at our disposal to navigate the course that's right for every investor, regardless of the market environment. Now is a good time to review your investments, your goals, and chart the right course for each unique investor situation. Okay, thanks for sitting through our State of the Markets presentation. Our compliance folks would love for you to read these important disclosures. And we have some more disclosures here. And with that, I want to thank you for joining us for our semi-annual State of the Markets presentation. Thanks very much.